You've seen the meme money printer go brr. It's funny, but it raises a real question. Can the US government just create unlimited money out of thin air? It sounds like a cheat code for running a country, especially when we see trillions injected into the economy overnight. In April 2020, the US created about $3 trillion, more than most countries' entire economies. Today, the national debt is over $36 trillion, a number that dwarfs the economies of China, Japan, Germany, and the UK combined. So why doesn't the US collapse into hyperinflation like other countries that print money? Why does the world seem to absorb America's money printing while others burn? The answer is more complex than a meme. It's about trust, power, and the US dollar's unique role in the global system. The US doesn't have a magical money machine, but it does have the world's primary reserve currency. This status gives America economic superpowers, but also huge responsibilities and risks. Let's unravel how this works. To understand why America's economic situation is unique, and why it seems to operate under a different set of rules than other nations, let's examine what historically happens when money printing goes wrong in other countries. We'll look at some stark examples of nations that attempted to solve their economic woes by simply printing more money, and the consequences they faced. In 1920s, Germany, during the Weimar Republic, the government, burdened by massive war reparations imposed by the Treaty of Versailles, resorted to printing vast sums of money to meet its obligations. The result? Hyperinflation so severe that the value of currency plummeted to unimaginable lows. A loaf of bread, a basic necessity, cost billions of marks. People's life savings evaporated overnight, rendering years of hard work and financial planning utterly worthless. The social fabric began to unravel, as trust in the government and the financial system eroded completely. Fast forward to Zimbabwe in the 2000s. Under the rule of Robert Mugabe, the government, facing severe economic collapse and widespread poverty, attempted to print its way out of trouble, flooding the market with newly created money. This led to inflation rates soaring into the sextillions, an astronomical figure that defied comprehension. Even a $100 trillion note, the highest denomination ever printed, could barely afford a loaf of bread. More recently, Venezuela repeated the same disastrous pattern, with hyperinflation reaching levels exceeding 1,000,000%, crippling the nation's economy and causing widespread suffering. The lesson from these examples? For most countries, printing money that isn't supported by real economic growth and productivity inevitably destroys trust and confidence in the currency's value and stability. And when that crucial trust vanishes, the money in your pocket, your bank account, and the national economy becomes effectively worthless, leading to widespread economic collapse and devastation. These historical disasters clearly demonstrate that unrestrained and irresponsible money printing is almost always a recipe for economic ruin and societal chaos. So why does the US seem to get away with it, at least so far? The primary answer lies in the consistently high global demand for US dollars, a level of demand that most other countries can only dream of achieving. For them, the money printer is a dangerous trap, ready to spring shut. For America, it's a powerful tool, at least it has been up until now. But even for the US, that tool comes with its own significant dangers and potential consequences. Let's delve deeper to see why the US appears to play by a different set of rules, and whether that exceptionalism can last. Why hasn't the US suffered the same economic fate as countries like Germany during the Weimar Republic, or Zimbabwe during its hyperinflation crisis? What makes the United States immune to the kind of monetary collapses that have plagued other nations throughout history? The simple answer, and the foundation of America's unique position, is that the US dollar is the world's reserve currency. It's the currency that underpins global trade and finance. When America prints money, unlike other countries, the world largely wants it. There's a seemingly insatiable global demand for US dollars. This demand acts as a buffer, absorbing the impact of increased money supply. Central banks, from economic powerhouses like China to emerging markets like Brazil, hold vast quantities of dollars as reserves. These reserves are a crucial part of their financial stability and international trade capabilities. The US has been running massive deficits for decades, a level of deficit spending that would cripple most other nations. In fact, the US has been raising its debt ceiling a staggering 78 times since 1960, a testament to its reliance on debt to fuel its economy. And now, interest payments on that debt are nearing $1 trillion a year, a substantial burden on the nation's finances. Yet despite this enormous debt and the rising cost of servicing it, investors from around the globe still flock to U.S. Treasury bonds, viewing them as a safe haven for their capital. Why this unwavering confidence? Because the dollar is the currency used to price and trade vital commodities, the lifeblood of the global economy, like oil, and of course gold, the traditional safe haven asset. If you want to buy oil on the international market, regardless of your country's currency, you ultimately need dollars to complete the transaction. This creates a constant, underlying, and truly global demand for the US dollar, a demand that is unmatched by any other currency in the world. The world's seemingly insatiable appetite for dollars effectively soaks up a significant portion of what America prints, mitigating the inflationary pressures that would otherwise devastate the economy. This unique position allows the U.S. to finance its substantial deficits and stimulate its economy through various measures in ways that no other country on earth can replicate without facing severe consequences. However, it's crucial to understand that it's not that fundamental economic principles simply don't apply to the United States. It's more accurate to say that the U.S. is playing the game of global finance on a different field with a unique set of advantages. When other countries print excessive amounts of money, they often witness their currencies crash in value, leading to economic instability. But when the U.S. prints money, a significant portion of that new currency is absorbed by the global economy, lessening the impact at home. This phenomenon is often referred to as the American exception, a privilege that is fundamentally built on the consistently high global demand for the US dollar. But it's important to remember that this isn't some kind of economic magic trick. It's a complex system, and like all systems, it operates within certain limits and constraints. The US can continue to do what other nations cannot, but only for as long as the global community continues to place its trust and belief in the stability and value of the dollar. Ultimately, that unwavering belief in the dollar is the true foundation upon which America's economic power and global influence are built. So, with that understanding of the dollar's unique position, let's delve deeper and look at the mechanics of how this money is actually created and introduced into the global financial system. When we say printing money, most people picture stacks of cash. But today, most new money is created digitally by the Federal Reserve. The process is called quantitative easing, or QE. Here's how it works. The Fed creates digital dollars with a few keystrokes. It uses this money to buy government bonds from big banks. Banks get fresh reserves which they can then lend out to businesses and consumers. This encourages more loans, more spending, and more economic activity. Cheap loans mean new factories, homes, and jobs. As the economy grows, tax revenues rise, helping the government. All this happens without printing a single physical bill. QE is a powerful tool to jumpstart the economy, but it's controversial. It can boost growth, but if overused, it risks fueling inflation or asset bubbles. The Fed's digital money creation is modern, fast, and global in impact. But it only works because the world trusts the dollar. Why does the world place its trust in the dollar? What makes this particular currency so globally dominant, so universally accepted? It's a question with a complex answer, one that delves into history, economics, and even a bit of psychology. It's certainly not backed by gold anymore. That direct link was severed decades ago. The answer lies in a confluence of factors, but if we had to pinpoint one, it would be history. The dollar's journey to global prominence is a long and fascinating one. Stability, a key ingredient in any currency's success, and the sheer size and dynamism of the U.S. economy. It's a powerhouse that underpins the dollar's value. After World War II, as the world rebuilt, the Bretton Woods Agreement cemented the dollar's role, making it the world's reserve currency. This pivotal moment established a new global financial order. Even after President Nixon ended the gold standard in the 1970s, a move that fundamentally changed the monetary system, the system stayed built around the dollar. The infrastructure and habits were already deeply ingrained. Simply put, there was, and arguably still is, no real alternative that possesses the same combination of scale, stability, and trust. The U.S. boasts the largest and most dynamic economy on the planet, a hub of innovation and productivity. It also has incredibly deep and liquid financial markets, providing unparalleled opportunities for investment and a relatively stable political system, at least compared to many other nations. Investors, both big and small, and central banks around the world crave safety above all else. They seek havens for their capital. They want assets that won't be seized arbitrarily, contracts that are reliably enforced through a robust legal system, and crucially, They need a government that has a proven track record of paying its debts, honoring its financial obligations. U.S. Treasury bonds, backed by the full faith and credit of the U.S. government, are widely seen as the safest investment on Earth, a benchmark for risk-free returns. The dollar's dominance is further reinforced by its central role in global trade. It's the currency of choice for international transactions. Oil, a critical resource for the modern world, and many other key commodities are priced in dollars. This means that any country that needs oil, which is virtually every country, needs dollars, creating a permanent and significant source of demand. As of 2024, the dollar makes up nearly 60% of global central bank reserves, a testament to its enduring appeal. No other currency even comes close to matching that level of global acceptance and holding. Ultimately, the world's trust in the dollar has become a self-reinforcing cycle, a virtuous loop that perpetuates its dominance. It's simply the default currency for global business, the language of international finance. It's a bedrock of belief, a source of stability in uncertain times, a safe harbor in a stormy world. But it's crucial to remember that trust, like any foundation, is not unbreakable. It can be eroded by mismanagement, instability, or the rise of credible alternatives. Here's where it gets interesting. When the U.S. creates trillions of dollars, you'd expect the dollar to weaken. Sometimes it does, but a weaker dollar can actually help U.S. exports, boosting demand for American goods. But in a global crisis, something unique happens. Investors rush to the dollar, not away from it. This is the safe haven effect. When the world panics, money floods into U.S. Treasury bonds and dollars. Even if a crisis starts in America, the dollar often gets stronger as global capital seeks safety. This acts as a shock absorber for the U.S. economy. Just when money creation might threaten the dollar, global fear props it up. After the crisis, the Fed can reverse course, raising rates and selling bonds to pull money out of the system. This helps control inflation and cool the economy. The Fed's ability to inject and withdraw money gives it control most central banks lack. The world's anxieties become America's safety net, but this system depends on continued trust. If that trust wavers, the safety net could vanish. Why can't other countries just print money like the US? The answer: global trust. Most currencies are only trusted at home. If Turkey or Venezuela prints money, nobody else wants it. There's no global demand for lira or bolivars, no one uses them to buy oil or as reserves. When these countries print money, it stays at home, causing inflation and collapse. Only the US can export its inflation because the world actually wants its dollars. America's power to print money is real, but risky. The system is built on global trust. If that trust erodes, the consequences could be severe. If major countries start dumping dollars, its value could plummet, causing massive inflation in the US. Borrowing would become expensive, imports would skyrocket in price, and a recession could follow. The very mechanism that protects the US could unravel in a self-fulfilling crisis. There's no immediate alternative to the dollar, but rising US debt and global shifts mean this privilege isn't guaranteed forever. The power is immense, but it's not permanent. America's safety net could disappear if the world's trust fades. So, can America create unlimited money? Not really. The US doesn't have an infinite money printer, it has global trust. This trust lets America do what others can't, but it's not a law of nature. The system works because the world believes in the dollar. Every new crisis, every political shakeup chips away at that belief. The US is insulated by the dollar's global role, but not invincible. America's power to print money is a privilege, not a right. If trust fades, the money printer stops, and the consequences could be dire.